Hey guys, I'm here at the park with my son on the swing there with my wife, and I just thought I'd do a quick video on how you can actually pay off your mortgage on your principal place of residence so much faster than you thought, right? So much faster. There's absolutely no reason to, get a 30-year mortgage and take 30 years to pay it off. So this video is going to be super helpful. And look, my name's PK and I help people achieve passive income through property by buying the combination, simultaneously positive cash flow and high growth property without using a buyer's agent, without needing to spend all that money, and also without needing to spend years or months doing research on real estate or domain or RP data, CoreLogic, or any of that sort of stuff. So let's get into it. There's a bit of a construction thing going on in the background, so hopefully it's not too noisy. But here's the thing. Look, 10 years ago, 15 years ago, 20 years ago, when interest rates were like up at 18%, 15%, 10%, it was like that made sense to then every dollar that you earned from your PIYG or from your business to put it into paying off your principal place of residence, because the interest that you're paying on that thing is huge, like 18%, 15%, 10%, right? And if you could have used the same money, the opportunity cost, if you could have used the same money to earn more than 18% or 15% or 10% per annum, you would have. But the reality is that it was very difficult to earn that kind of return on investment. Therefore, it just made sense to use your money, and the best financial sense was to put it into your principal place of residence. Because in one way of looking at it, by paying your principal place of residence down, you are making 18% per annum or 15% per annum or 10% per annum, because that's what you were saving on not having to pay your mortgage, right? So that was the logic, and it was very sound. But what the mistake is that most people make in this day and age is that they still go by that bias, right? They still think that paying your mortgage down, right? So you've got a $500,000 mortgage, $700,000 mortgage, $300,000 mortgage. They still think that the wisest thing to do is to pay that mortgage down, when in reality, the interest rates right now are not 18%, are not 15%, are not 10%. They're not even 5%. In fact, if you're paying more than a 2 or 3%, interest rate on your mortgage, then, you really don't have a great deal, okay? So the key thing that I want people to understand from this video is that in this day and age, we're in 2021, if you're still trying to pay your mortgage off, or if you're at least trying to get that mortgage, halfway down or something like that, then that's just not wise financial decision making. Now, I know that this goes against the grain, but in other words, what you're doing is you're saying, okay, let's say I earn $100,000 per annum and I save out of that $30,000 per annum. Just, random numbers, but just go with this. I'm going to use that $30,000 to pay off my mortgage, and every year I'm just going to pay it off, right? Now, what you're really saying is that I'm happy to earn 1.5 or 2% interest on that $30,000, because that's in fact the interest that you are saving by paying off that mortgage. Now, if I asked you, hey, look, I've got this amazing deal, give me $50,000 of your hard-earned money, and you know what? I'm going to give you like 2% per annum. Would you go for it? Would anyone go for it? I don't think anyone that will watch this video on YouTube, Facebook, LinkedIn, Instagram, I don't think anyone would give me your hard-earned money, $50,000, $100,000, even $30,000 if I promised you 1% return or 2% return. But that is in fact the outcome that you're achieving by paying your mortgage down. All right, so I'm not here to tell you to take huge risks or anything like that, but the reality is that that is in fact the financial decision that you are making if you are paying your mortgage down. And I know that it seems that you're reducing your risk. I know that it seems that that's what you're meant to do. But the way to pay off your mortgage faster is actually not to pay your mortgage off at all. Okay, connect with this point. The way to pay your mortgage off faster is actually not to pay your mortgage off at all. So let's just go through one hypothetical scenario. Like I could do a 3-hour video on this and do for my clients, but let's just go with this for the moment. Let's say you have that $100,000. Let's not even say 100. Let's just say $50,000. Instead of paying $50,000 off your mortgage, you could take that $50,000 and buy a $350,000 property. Okay, so now we're talking about return on investment. Stick with me here. You buy a $350,000 property with that $50,000 at like a 90% LVR, or I've done different videos on why 90% or 88% is better than 80%, what LMI is, what the benefits of LMI are, all that kind of thing. I'm not going to go through it now, but let's just go with the flow, right? So you've taken your $50,000 and you have put it into a house, buying it at $350,000. Now, if you are doing things correctly, that $350,000 house should give you a positive cash flow on an interest-only basis after all expenses, after council rates, property management fees, after, all that good stuff. It should give you around, let's say, $3,000 to $5,000 positive cash flow every single year. Okay, and I'm not making this up. I post videos about this. I post client results about this every single week. So let's say you bought that $350,000 property and you are now earning $3,000 to $5,000 positive cash flow every single year. Okay, now that in of itself has already beaten the return on investment that you were getting from paying your mortgage off, because that $50,000 paying your mortgage off was saving you like $1,000 or $2,000, if that, in interest every single year. Okay, so you've already beaten that return on investment, but the story doesn't end here. The truth is that it's entirely possible to predict consistently which suburb, which property worth $350 will go up to $400,000 in the next 12 months, or let's say maximum 18 months. Okay, so let's say that $50,000 that you've spent is become, or you've bought something for $350 and that's become $400,000. Okay, entirely possible. In fact, that's a pretty conservative outcome. So that $50,000 has now doubled. Okay, plus you're making that $3,000 to $5,000 positive cash flow. So that $50,000 is now become $105,000 after a single year. Now, of course, I'm not here to say that kind of capital growth is what you can expect every single year. Properties don't grow, on a linear basis. They don't grow consistently in a straight line every single year. But if you buy well, they do in fact grow. But even if we just take the first year's sample, you've taken your 50 grand, it's given you $3,000 to $5,000 positive cash flow, plus $50,000 of capital growth, which on a cash-on-cash basis, that $50,000 has become $105,000. Okay, and that has completely obliterated, demolished, and completely destroyed the return on investment that you were getting by taking that same $50,000 and paying your mortgage off. Because the return on investment from paying your mortgage off is the interest rate that you're having to pay on that mortgage, which, like I said, let's say it's 2%. 2% on $50,000 is $1,000. So you've beaten that $1,000 return on investment by an unlimited multiple. It's not unlimited, but I'm just using that as an hyperbole, right? On one side, you paid your mortgage off and saved yourself $1,000 or $2,000. On the other side, you've taken that 50 grand and made another $55,000 in a single year. I mean, that's amazing. And sometimes people talk about stock investing and all this sort of stuff, but the reality is that I don't care how good you are at stock investment, none of you watching this video, including me, can consistently make $50,000 in the stock market become $100,000. You can't consistently get a 2x return, and you can in real estate. The difference being leverage. Of course, you can leverage in the stock market, but that is very high risk. Something called a margin call, where the bank can just come and say, look, we don't care that you've taken out a loan, we want all of our money back immediately. That doesn't happen in real estate, at least not in residential real estate. Okay, so here's the thing. If you want to invest in the stock market, be leveraged. Be leveraged by taking the equity out of your property, whether it's an investment property or an owner-occupied. But that's, I digress. That's a tangent. Back to the principle. The way that you pay your mortgage off faster is, instead of paying your mortgage off, you just take your 50,000 this year. Maybe in a couple of years you have another 50,000. Maybe in another few years you have another 50,000. Buy 3, 4, 5 properties. It's not like you need 10 properties. You don't need to be one of those heroes on Instagram or Facebook that has 20 properties in 2 months, or 20 properties by the age of 20, or 10 properties in 10 years. You don't need any of that stuff. All you need is 3 to 5 properties, and each of them giving you that kind of 100% cash on cash return. You just hold those bad boys for 5 or 10 years, and even if you just sell 1 or 2 of them, that will pay off your entire principal place of residence debt, mortgage, immediately. Not after 30 years, but after 10 years at a maximum, right? I mean, of course, the more you buy, the quicker the multiple assets will rise, and you can take that cream, that equity, and pay off your principal place of residence. But the point is that paying off your mortgage on your principal place of residence is not the way to pay off your mortgage faster, okay? I don't know if that actually makes sense. The way to as quickly as possible, pay off your principal place of mortgage is actually not to pay it off at all, is to use that money, put it in higher returning assets, investment properties, buy 2, 3, 4 of them, allow those to increase over time. Of course, we want short-term growth, like I demonstrated, but we want them to increase over time. And in 5 years and 7 years and 8 years, like, this stuff it's not theoretical. I'm not talking about unicorns and dragons here. I'm talking about stuff that like so many people do. You just need it to be positive cash flow so it doesn't affect your lifestyle. You need those properties to rise in the first 5 years, and after 5 years, after 7 years, after 8 years, you can sell 2 or 3 of them. They haven't cost you anything to hold, and if you're not interested in making passive income, you can just sell them and pay off your principal place of residence, right? And in that way, you have no bad debt, you have no non-deductible debt, and you can live life. These methods aren't going to get you a Ferrari or a mansion, but these methods allow you to live in a stress-free way, right? No one likes non-deductible debt. No one likes a mortgage sort of like a monkey on their back, hovering over their head like a rain cloud. It's like a burden, it's stressful. This is the easiest and best and quickest and most streamlined way to pay that mortgage off ASAP. Okay, so look, if that made sense, or if it doesn't make sense, just ask your questions in the comments below. Like, I'm genuinely trying to help you. This isn't kind of some sales pitch or anything. Like, this stuff actually works. And if you're not quite sure how it works, just ask all your questions in the comments. Everyone can see the answers. I'm gonna tell you as much as I can. I'll tell you based on what you're confused about. The thing is that, like, if you're genuinely trying to pay off a mortgage over 30 years, like that, in this day and age, just doesn't make sense. If we were in the 90s, if we were in the 80s, or even in the early 2000s, when interest rates were 10, 15, 18%, then this video would be irrelevant, right? Because it's pretty hard to say to someone, don't make 18% per annum by just paying your principal place of residence off, right? That's a hard sell. But right now, with interest rates like less than 2%, like, it just doesn't make any sense, guys, for you to like use your hard-earned money that you go to 9 to 5 job, like, every day for the whole year, just to make 1% on that. It doesn't make any sense. Yeah, so look, if this video actually makes sense and it adds value, I know it's probably gonna like shake you up a little bit perhaps, and it's gonna reveal more questions and answers maybe. Just ask those questions in the comments. Like, don't just leave this video and say, oh look, that was cool, I'm not sure if it works or not. Anyway, it's too high risk, I don't want to think about it. Like, this is your own money. I don't care about your money as much as you do. Only you do, right? So hopefully this adds value, and if it does, just leave a like or a love or subscribe if this is if you're watching on YouTube, right? The more you interact with this video, like, I'm not here to, of course I'm here to sell something, but this is for your benefit. If you interact, then more people will see it. That's how the algorithm works, and more people will not have to be stuck in a 30-year mortgage. That's just, That's just ridiculous, like dinosaur thinking. It's like, you know, so archaic. So yeah, look, I'll leave a comment below on how you can learn more to actually do this. You don't need my help so much to do it. You just need a bit of education. You can buy these properties yourself. You know, I'm not trying to sell you a service to say, give me 15K for every property. That's not what I'm about. I'm here to educate you, because if I can teach you how to fish, then, you know, you're self-sufficient for life, right? That's the most rewarding feeling. Okay guys, well, my name's PK and hopefully this was super useful. Any questions, like I said, just leave them below. Have a fantastic day. Hopefully my wife and son are still at the playground. See you later.